what's up? Red Panda Anthem. Red Panda, what's good?
Well, let's talk about some investing stuff. Ray Dalio.
Yeah.
He retired from Bridgewater, which is the largest hedge fund in the world, I believe.
Yes.
Last week. So what's the deal with that? That was something that kind of caught people by surprise. What does this mean for the overall market? What's your thoughts on Ray Dalio stepping down?
He's been planning this for 9 or 10 years. It's twofold. So I told on one end, people shouldn't panic solely because he chose to step away, because he's been planning this for a long time. I've actually lost count of the number of CEOs and chief investment officers that have stepped down. But I do truly believe, seeing the landscape that we were in, he wanted to go out on a high horse and didn't want to face the recession that it hasn't been announced yet, but the recession that we're in and whatever's in between the recession and depression, I think we're going to hit that level sometimes next year. I think he wanted to go out and be able to enjoy parts of his life. He sacrificed a lot, lost a son, put a lot into Bridgewater, gave up a lot of time, wrote 2 amazing books that I recommend everyone go read. Huge loss for the investing community. I cannot lie and say, well, it doesn't have an impact on the market, because I think if he thought the market was going to turn around in 23 and 24, he probably would have stayed. So it's no different if Buffett chooses to step down summer of next year. It is going to have an impact on the market. So for the next 18 months or so, I think it is a signal for how rough things can be for the next year to 18 months. But he deserved to retire. He had this in motion way before the 2020 recession came about, and even so now. But I do think he wants to stay out of the storm that is coming next year, in 2024.
The fund itself is performing well, but like you said, this has been in the works, right? Like this is, if you watch the show on HBO Succession, like this is the definition of a succession plan, right? So like he steps down in 2017 as a CEO, in 21 he steps down as chairman, and even now, like, he's transferred the majority stake of the board, but remains a meaningful owner in the fund, right? So like he still has equity inside of this fund, but he's also stepped down as one of the 3 co-chief investment officers, but he's going to remain as a chief investment officer mentor. And so like, obviously in that role, I could just imagine him seeing who's going to be the next person or the next couple of people or group of people who'll be able to facilitate in his role. And now he has a hands-on relationship with them, being able to mentor them to actually make sure that the fund is in good hands. Because at the end of the day, it's always going to be attached to him. So you always want to make sure that it does well. But it does free up some of his time to actually do things that he may want to pursue. So yeah, this is a succession plan.
Absolutely.
So this
executed very well.
This isn't something to be concerned about.
No. If it was like out of nowhere, then I could see it like, wait, all right, this is a little tricky, right? Like they keep saying it's going to be a recession. Well, by definition, it hasn't really been. And then obviously we saw what Jamie Dimon said today. If you didn't, he says in 6 to 9 months. Yeah,
6 to 9 months. Even though I guess the first time in history we need 3 or 4 quarters of negative GDP growth. We've been in one.
We've been in a recession.
The definition has changed, but I think the last, like, that tipping point is the jobs report. And so like when they start seeing the jobs report or jobs being created or unemployment rates like turning inverse, where the unemployment rate's going up and jobs aren't being created. I think they said the number, it's probably around like 100,000. If we only had 100,000 jobs on a jobs report, then it would be like a sign like, okay, a recession might be here. But
the recession's already here. That doesn't.
No, I'm saying by definition it is. But one of those indicators is like, what's the unemployment rate? How many jobs would be created? The fact that the jobs report, I think there was almost 300,000 jobs created in September. No, was it August? Maybe August. The last jobs report. It still showed that it was positive. So once that starts becoming negative, then it's like full on recession. By definition, it's two.
But it's really not, though. That's what I'm saying.
What I'm saying, by 2 to 3 quarters, by definition, that is.
That's the only definition.
Yeah, two negative. And I always ask, what are the quality of the jobs? Because I feel as if as soon as they announce recession, the most valuable companies are going to skyrocket to the upside. You're going to see them deploy capital so fast that the average person is not going to have a chance to catch up and then buy in.
Yeah, we got to, you just got to go by the language. A recession is 2 negative quarters of GDP growth. So all of these new indicators and No, it's really not what it is. And we've been in a recession for the last 2-3 months. So
Yeah.
I don't understand why they just don't say it's a recession. Now, it is a recession
Politics.
because the last 2 quarters were negative. It's just that simple. It's not even, we're making this more complicated than it needs to be. But, you know, I just feel that it's a lagging. A lot of these things are lagging indicators as well. By the time they actually announce that we're in a recession, we're going to be coming out of a
But
recession.
it's tough. So like when even like if you think about it, I think Josh Brown has said this, but even if you think about the time when that definition was created, for those times, the 2 negative quarters were fit. But these are different times, right? So maybe having that, and maybe that's part of the language. It's like, all right, let's pull off on using the word because there are different circumstances in this economic climate.
But if it was Obama in office, it wouldn't be a different set of circumstances. Maybe majority of the hedge fund managers and bankers lean left, and they don't want Biden to have the recession on his presidential jacket. And as Obama said, and Biden gets shellacked when it's time for re-election. Because if you have the recession, fellas, it's like, okay, if you're broke and you have like negative $50 in your account, you cannot say I'm cash flow positive. So like now the Fed is playing games with where we stand. We've been negative. And if you actually look at it, if you factor in COVID and take out quantitative easing, we've technically been broke since 2019. That's when all the PPP money came in, all the business money came in, the NFT market came in. I reposted the, Logan Paul or Jake Paul, I forget which one, bought an NFT for $695,000 is worth $10 now. I told you guys last year, they were going to push up the market and give everyone one last chance to get money in 2021 for what's to come. And now we're here. I agree with Rashad. Like 2 negative quarters is 2 negative quarters. If we were leading the country and we didn't get positive growth, they would say, hey, we led everyone in Market Mondays to a recession. The dynamic doesn't get to change now. And the jobs are not that high quality that they are producing and bringing in right now.
That's the other part. That part.
Well, we'll see. But speaking of recession, what are 2 stocks that are doing incredibly well in this recession and that we should keep our eyes on?
There are a couple that I like. If you look at IRDM, that is one you guys can add to your watch list. Another one is General Dynamics. The ticker symbol is GD. And if you need an inverse, I don't want you to hold this one forever or even for longer than 5 days. But SQQQ. So that's the inverse ETF of the triple Q. So if the NASDAQ goes down, this stock goes up. So in order, IRDM, number 2, General Dynamics, and then SQQQ. And for my traders, you should look at the wheat future to trade that as well on the upside if you're looking for something that's been having positive growth over the last 3 or 4 months.
Yeah. I'll just add 2. And we kind of had a call about it, Ian. It was actually on the other day when I was like, look, when we saw that OPEC news, and I was like, wait, oil's going to get cut like 2 million barrels a day. Obviously, that's going to take effect in November. But if oil production is getting cut, that means oil prices are going to go up. That means companies that produce oil or are in the oil industry, their price is going to increase. And so if you look at just the energy sector, ExxonMobil this year is up 42%. ConocoPhillips is up 42%. And the one we kind of were speaking about, and I actually text Shadi and Bam about it, but Marathon Oil is one of those ones, MRO. You should definitely keep
that's a nice home run you hit.
yeah, that's a nice one. We'll talk about that another time. But yeah, that's up 37% for this year. And so, I mean, sometimes it's like, yeah, you check out the news and it's like, all right, do what you want with it. But when you hear like global news, like when they're saying, hey, we're going to meet in Vienna. No, we're not doing this on a Zoom call. Everybody needs to come to Vienna to meet. And then you hear how the White House has terrible like feeling about it. They don't even want to come and they're disappointed in the news before it even comes out, right? The initial report was that they were going to pull back 500,000 barrels a day. And so to hear it go up to 2 million, it's like, okay, well, that's going to increase the amount that oil is going to cost going forward. So yeah, those are solid places, especially in a climate like this.
Yeah, and remember, SQQQ is not a long-term hold; it's an inverted ETF, so you don't want to.
Yeah, I will hold it for 3 to 4 days maximum. For the record, Mike, can we clip that up?
Yeah,
Nikki, can we clip that up? Yeah, 3 to 4 days maximum.
And an inverted ETF, it goes opposite the direction of the market. So if anybody that's new to Market Mondays and has never heard the term before, so that means when stocks go up, the inverted, they go down. When stocks go down, the inverted ETFs go up. So yes, that's what that is. So QQQ is the technology ETF, where it has Microsoft, Apple, Amazon, all of those technology companies in it. So obviously the the NASDAQ, I think, hit a 2-year low.
Yeah.
Since the COVID first hit. This is the lowest point since March of 2020 when COVID first hit. So the stock market has been getting hammered, but the technology, and remember I said technology stocks were inflated?
Yeah.
Because they were.
Yeah.
So it's like it's just a common thing, right? Like when things go up, they must come down. And when things go up higher than everything else, they're gonna go down harder than everything else. And that's exactly what happened. You see the NASDAQ now is down 34%. 34%.
Yep.
The general stock market is down 20-something%.
Yeah, Dow was down 20, S&P down 23.
And also when quantitative easing goes away and inflation goes up high, I asked a question for everyone, like, when does the 2-Tech-2 index model start to erode once you get past 15%? You have to know those key levers. Like, that's one of the things that Leisman talked about a lot. If you don't know what moves the markets, number one is always going to be quantitative easing. When we're going to hit recession, inverted yield curve. We talked about that the first season of Market Mondays, right? So those are the two things you have to look out for the most. But if the Fed is not printing money, everything is going to come back down to the normal levels in which it should be.
This that Red Panda Anthem. Ian, what's up? This that Red Panda Anthem. Red Panda, what's good? Red Panda Anthem. Whole clip going up. I know they can't stand it.